Welcome to our long-term care planning workshop. Today we will cover long-term care insurance versus planning, how it benefits your relationships, the activities of daily living, Medicaid, when you should purchase, the elimination period, tax implications, and cost and comparison. Raphael E. Pino said, "Perspective is the way we see things when we look at them from a certain distance, and it allows us to appreciate their value." Even though we're discussing a type of insurance here, it's arguably an incorrect perspective to think about it as long-term care insurance. A more accurate perspective is to think about it as long-term care planning. The issue is not insurance, but long-term care. This discussion is about what the consequences of not having a plan for long-term care will have on the emotional, physical, and financial well-being of your family and how it impacts the relationships you have with them, as well as your friends. Long-term care allows your spouse to maintain the relationship with you as a spouse, supervising, not providing care. Your children to maintain the relationship with you as children, supervising, not providing care. Your siblings to maintain their relationships with you as siblings, supervising, not providing care. And finally, your friends to maintain their relationships with you as friends, supervising, not providing care. Medicaid will pay for the custodial care in a good nursing home. The issue, however, is the majority of your care will be provided at home, and Medicaid pays little to nothing for home care, adult daycare, or assisted living. Besides, would you rather be sent to a nursing home or be cared for in a familiar environment? Medicaid does not pay for care where you need it most, in your community. Long-term care insurance covers you for a host of services known as activities of daily living, or ADLs, that aren't covered by regular health insurance or Medicare. These include bathing, dressing, continence, eating, transferring, and toileting. A long-term care policy also helps cover the cost of care when you have a chronic medical condition, a disability, or a disorder such as Alzheimer's disease. But you won't qualify for LTC if you already have a debilitating pre-existing condition. This is why it's important to purchase this coverage while you're still healthy. Under most policies, you'll have to pay for long-term care services out of pocket for a certain amount of time, typically between 30 and 90 days, before the insurer starts to reimburse you for any care. This is called the elimination period. After that, most policies will reimburse you for care given in a variety of places, such as your home, a nursing home, an assisted living facility, or an adult daycare. There are a lot of advantages to owning a long-term care policy. It helps people remain in their home as long as possible, ensures parents won't have to rely on their kids to take care of them, and provides protection for a retirement nest egg. But there's another important advantage: the potential to save on federal and state income taxes. Additionally, qualified LTC plans payout benefits are 100% tax-free. In order to be tax qualified, a long-term care policy must contain certain required provisions. If the policy contains all the required language, it generally can be considered a qualified long-term care insurance contract for tax purposes. Some of these provisions include an expectation that the disability will be long-term, 90 days or longer. The insured must be certified within the last 12 months as chronically ill with the inability to perform without assistance at least 2 of the 6 ADLs. And finally, the need for substantial supervision due to severe cognitive impairment in order to protect the insured from threats to health and safety. Policies issued before 1997 are considered to be grandfathered into the law and are considered tax qualified. Policies issued after January 1st, 1997 that do not meet the above requirements are classified as non-tax qualified plans. The benefits paid by a tax qualified long-term care insurance policy are intended to be tax-free as long as they do not exceed the greater of qualified long-term care daily expenses or the per-day limitation, which is $380 in 2020. This is just a little bit of the information about the tax implications. I highly advise you to please consult your tax professional for additional rules and specifications as they pertain to you. As with other types of insurance, whether or not you already have long-term care, it's a good idea to sit with a trusted broker to help you compare the costs and benefits of the available providers to make sure you choose the best value for your money. Thanks for joining us. I hope you got a lot out of this presentation today. And if you're interested in more of the services that we provide or would like to schedule a free consultation, please visit our website at setsailins.com. And don't forget to subscribe to our YouTube channel to be notified on new content. Thanks. We'll see you soon.